As the market kicks off a new year, it seems to be making a run. Two of the three January effect indicators that we watch have checked the box to the positive, so it's interesting. We're about to enter earnings season, which will be the real telltale of this market. And stick with me as we talk about the odds of the market moving forward into 2023. My name is Brian Cannon, and welcome to Markets in 5. All right, so getting into the S&P 500 for 2023, you can see a couple of things going on. So obviously we've got this major trend line to the downside that's been very, very difficult for the S&P to break. In fact, it hasn't broken it yet. So it knocked on the door a couple of times last year, couldn't get through it, came around, and now we're approaching it again. So it did break through the 20, the 50, and the 100-day moving averages, so that's all good. We've got a kind of a little bit stronger test with the 200-day moving average coming up. We're right below it. But I think the real test in this market is breaking through this downtrend resistance level. And again, once we do that, are able to break it to the upside, a lot of times what is resistance, again, will turn around and be support. So it'll probably break through it and then come back down and test it at some point and then take off. And then that would be the really good sign to get back in. But that's kind of what we're looking for. But we are seeing a positive crossover here on the MACD. And we are seeing RSI positive above 50. Now, what's interesting, and I circled a couple of areas here where the RSI is either consolidated or struggled to get through or used it as support. And so we're approaching that area now. So again, just something we're watching. Says we're very close to this kind of area that the RSI struggles. We're also approaching the long-term downtrend resistance line. So we've got about 1% in order to hit that line. So not very much. And to me, it's not worth taking a whole lot of risk for 1% when we've got a much larger downside if it can't hold. All right, this is a little bit longer term picture of the S&P. And again, you can kind of see that, it just kind of brings it into light a little bit, the importance of this downtrend line and how everybody's paying attention to it. Traders, institutional buyers, individual retail investors, and so again we've got a breakout here on the RSI. We've got a positive turnover on the MACD. So yeah, it's looking positive. It really is. So as we're approaching earnings season, which is coming up Friday with a lot of the big banks, that'll be a real interesting kind of kickoff to earnings to see how the banks are doing. And we've got some inflation reports. So we've got CPI coming out on Thursday morning. So we'll see what that does. But essentially, that's really what we're looking for to, I would say, go back in any meaningful way would be, breaking out of this downtrend. All right, so when we take a little bit longer look at this, you can see, again, I had pointed out before the very natural level for if the market can't continue going up and does in fact roll over and turn down, a very, very natural level would be, one of these two red lines, with this red line being probably the most realistic, would be coming down, hitting the pre-pandemic peak. And that also coordinates with the downtrend line that we've established for this major bear market we're in. So we've got a 1% upside to hit the upside resistance level before we would feel comfortable starting to go back into the markets in a meaningful way. And we've got a downside of about 15%, which would be kind of an area would be very interested in getting back in as well. So 1%, 15%, I think we can be a little bit more patient and just kind of see where this thing goes. But again, with earnings season and CPI and a Fed that basically has told us so far that they're going to make some decisions that are politically not favorable. They're basically telling us that they're going to do everything in their power to control inflation. So, we've got to respect that. And, obviously if the numbers come down, that's great. We can get back in, but if not, the Fed is going to continue their aggressive stance, in my opinion. So we've just got to be careful and manage the risk appropriately. So in wrapping up, you can see that we're so close to either breaking up or breaking back down. And the odds are not favorable to taking a lot of risk at this point until we get a solid break. When that happens and the coast is clear, we'll be back in. But until then, we're just going to play it a little bit cautious and make sure that we're protecting on the downside. But if you have any questions, give me a shout. My name is Brian Cannon, and I'll see you on the next Markets in 5.